Two legendary market experts are stepping forward to warn we're in the earliest stages of what they call the Great Unraveling, a specific event starting to take root in America that's behind the recent crash in stocks and the record inflation you're seeing. But they worry it's about to get even worse. And many of the things you take for granted are due for a big disruption in the months ahead. Your Social Security benefits will likely be slashed. Your taxes are probably going way up. And many of your investments are likely to continue falling. Meanwhile, even if you think you've saved enough money to retire, you're probably going to need way more money than you thought. Your personal success all comes down to how well you understand what's heading your way. This is why I strongly encourage you to read about their warning today, totally free. It's all spelled out in a free report we've put together about the Great Unraveling. Get the facts yourself. Go to unravelingreport.com to get your free copy of this report. You can learn how to get their full playbook to prepare for what's coming. Again, that's unravelingreport.com for a free copy of this new report. Hi, this is Daniela Cambone. Welcome back to the Daniela Cambone Show. Our Outlook 2023 continues with my guest today, Rick Rule. Rick, always good to have you on. Thank you for being with us.
Daniela, thank you for having me back. I've enjoyed our interviews over the years, and I look forward to many more of them.
Yes, well, we have a lot of ground to cover today. I have a lot of homework for you to do, a lot of analysis. We all know the narrative now. The Fed raised interest rates another 0.5 point, but slowing the pace of hikes. We have the ECB raising rates. We see inflation cooling. Now, the last time we spoke, you kind of prepared us for this, saying even if this were to happen, the pain doesn't just go away. So I want to know where you're at now, given the new information we have, even though it's probably not a surprise to you. Where do we go from here from the Fed?
I need to begin by saying I'm pleasantly surprised at the resilience of the U.S. economy. The pace of interest rate rises that we have withstood with the relative lack of pain in the economy. By the way, I'm not saying that nobody has felt pain, but the relative lack of pain that we felt in the economy has amazed me. And in the near term, I would suggest that I'm bullish on the broad economy and equities, both because we've been able to withstand the pain, but also because there are literally trillions of dollars sitting on the sidelines. Investors are really cashed up. Before I come away as too bullish, however, I would suggest to your listeners that the effects of interest rate rises often lag, which is to say, as an example, the doubling of the 30-year mortgage rate has resulted in a slowdown in single-family residential sales. But we haven't seen wholesale price declines because people haven't been willing to lower the ask prices. What we've seen is a sort of a hiatus in transactions. And my guess is that as the impact of higher interest rates gets felt through the economy, that the reaction of the economy, that is the negative reaction of the economy, will start to pick up. I also would caution investors to understand that increasing interest rates are very bad for the long bond market and can be bad for the equities markets too. Bad in the sense that companies' costs of capital go up at the same time that the capitalized value of distributions, that is the competitiveness of dividends relative to other savings products, declines. I am amazed, really, at the resilience of the U.S. economy, but I remain very cautious in the face of higher interest rates.
Interesting. Now, when you say you're bullish U.S. equities, I mean, is that a change?
In the very near term, Daniela, the very near term, I think we have a chance for a rally, for a bounce, simply as a consequence of the fact that there is so much cash on the sidelines.
Interesting. So you mean like near and it's going to be short-lived, and then what happens?
My suspicion is it will be short-lived.
Okay.
My suspicion is that we haven't felt the entire impact of higher interest rates. Higher interest rates are bad for almost all asset classes. But counteracting that has been the amazing resilience of the U.S. economy, the amazing resilience of earnings, and the fact that individual investors and institutional investors have so much cash on the sidelines.
But what happens if they really do, pull in the reins, slow in the pace, perhaps no other rate hikes? How does that change the narrative, or you think that's off the table?
I think that they will continue to raise interest rates as long as they can.
And that's what you've been saying.
Remember that
Yeah.
remember that although the nominal interest rate has increased quite a bit, we still have negative real rates. Inflation is slowing, particularly if you do as they do, which is to exclude food and fuel. One would presume that the Council of Economic Advisors neither drives, nor eats. But it's important to remember that real rates are negative. If you look, Daniela, as you and I have done for
Hmm.
more than a decade at the U.S. 10-year Treasury,
Yep.
they propose to pay you 4% in a currency that they acknowledge is depreciating in terms of purchasing power by 7%, which is to say the real rate still penalizes savers as to 300 basis points a
Yep.
year. If they are able to address that, which I don't think they'll be able to, without a really truly meaningful impact on the economy, then things change. And if we begin to see a lagging effect of interest rates in equities markets, but also in general economic activity, I suspect that the political pressure on the Fed
Right.
to pivot will be very strong.
I would have to agree with you. And let me get your take on the inflation. I mean, there was some enthusiasm like, yay, it's cooling. But if we compare it to what happened in the 1970s, we saw that, the waves of inflation are not just one wave. They came actually in three waves. So what's your take on inflation? Is there any cause for celebration or not so fast here?
Danielle, I'm amazed that a woman as young as you has a memory of the 70s.
I
But
do not.
what you say is very, very accurate. In the 1970 to early 1975 period, we had galloping runaway inflation as a function of very low or negative real interest rates. The Fed raised the interest rate in 1975, cratered the gold price, but cratered the economy too. And in 9 short months, the Fed caved to pressure, reversed, and of course, gold and inflation were off on a real romp. Is past prologue? I don't know. My fear is that past is prologue. My fear is that the structure of the U.S. economy is too dependent on artificially low interest rates and too dependent on liquidity. But I need to say, I am impressed by the resilience shown by the U.S. economy, and in particular by earnings
Yep.
so far.
Is it a fair assessment to say that 2022, looking back, Rick, was quite an anomaly? And I'm going to just point to some data points here. We saw the 20 biggest drawdowns for the S&P going back to 1961. It's the only year in history where treasuries have lost more money than stocks. So basically, risk off did worse than risk on. And the percentage of weeks that the S&P lost money this year was 63% of the time. Is it an accurate statement to say this was an anomaly, it was a hell of a year, and not in a good way?
I'm not sure it was an anomaly, unfortunately, Daniela. I think we went through 40 years of benign economic climate, 40 years of declining real interest rates, 40 years of the benefits of demographics. And I need to say that, with the exception of benefits that we will continue to enjoy from better technology and more inclusion in the workforce, I think those benign times are past us. Peace was breaking out around the world for 40 years. There was an inclusion of more people in the workforce. And in particular, we had 40 years of declining interest rates, both real and nominal interest rates. That party's over, I think, for a while. The consequence of that is that we need to adjust ourselves to a new normal. And 2022 might be a preview of coming attractions. I would note, too, that the
Yeah.
decline that we had was a long, slow, grinding decline through many markets, but not the sort of sharp break that we experienced, as an example, in 2008. While what you say is true with regards to the number of days that the S&P declined, the fact that the S&P didn't decline by more in the face of a doubling of interest rates and a doubling in the yield on competing products, I think really is testimony to people's belief in equities. I'm not sure that belief is well founded, Daniela, but I think what we saw in 2022 is something that we're going to need to become accustomed to.
Yeah. Okay. So I like that statement. I think it's an important one where you say it's more of a preview of things to come, of our new normal. Can you elaborate a little bit more on that? So enthusiasm in equities doesn't go away.
I
inflation doesn't
think
go away.
people are going to have to become stock pickers, Daniela. I don't think that you're going to be able to buy the market because I don't think that the market is going to have the demographic tailwinds. I don't think it's going to have the benefit of globalization. I don't think it's going to have a continued benefit from inclusion in the workforce because female employment is running very close to male employment. I don't think that we're going to have the benefit of declining nominal or declining real interest rates. I think we will continue to have bright spots. I'm still delighted by the pace of American and, frankly, global ingenuity. We've talked before, Daniela, about the fact that our economy, despite our best efforts to wreck it, is still a place where 5 or 6 young kids can commandeer a garage in Sunnyvale, California, and out pops Google or out pops Apple. And
Or
that will continue.
or I was gonna say,
There,
or out pops FTX, but we'll talk.
well, that wasn't a garage, that was a penthouse, but we'll leave that alone. Um,
And in the
and,
Bahamas.
and
But anyhow.
yeah, there will be problems. As I say, I think we're coming into a stock pickers market. I think that you're going to need to find enterprises that add real value. I don't think that you're going to be able to jump on the U.S. stock market as a whole. I don't think that you're going to be able to jump on one of however many thousands of ETFs exist and benefit from extraordinary economic tailwinds. But I also think that an investor who keeps his or her head and invests intelligently in businesses, not in the market, will continue to do extraordinarily well, just as Buffett did extraordinarily well in periods of time like the 50s and the 60s and the 70s and the 80s.
And
I think there's going to be a lot of money to be made. It's just not going to be made as ubiquitously as it has the last 40 years.
let's talk a little bit more about the U.S. economy, specifically the U.S. dollar. We've seen the brakes placed on the U.S. dollar a bit. Where does it go from here? Does it remain the strongest?
I think in relative terms, yes, it does remain the strongest. I think the U.S. dollar is the deepest. I don't think, I know that the U.S. dollar is the most liquid and also the most transparent market in the world. It's a freely convertible currency. I think that the United States government is doing its very best to wreck the dollar by weaponizing it, by extraterritorial imposition of U.S. law and value. In other words, we are driving China, we are driving India, we are driving Saudi Arabia out of the dollar to the best that we can. But the dollar as an instrument is probably so strong that it will defeat the government's efforts to wreck it. It's amazing how ironic that sounds. I know from my own experience with very large Asian pension fund investors that although they don't trust us, and although they don't particularly like the value proposition around the U.S. Treasury, they don't believe that they have any alternatives with regards to the depth and liquidity and transparency in the market, which is to say, as little as they trust us more than they trust the other superpowers and trust us more than they trust each other.
Why would they want, are they purposely wrecking it or blindly wrecking it? And if they're purposely wrecking it, why would they want to do that?
I would argue that there's a little bit of both, but mostly they're blindly wrecking it. I think the political class in the United States doesn't know and doesn't care very much about a free economy. They know and care a lot about politics and power. And trying to enforce U.S. foreign policy goals often means debasing the trust that the rest of the world has in the U.S. as a consequence of trying to export U.S. values and laws in an extraterritorial sense. To the extent that we want to fight China, rather than trying to outcompete them in the economy, we try to hobble them by restricting their access to our currency. That in and of itself debases the trust that China might have, as an example, in the U.S. as a global economic arbiter.
This is an important point, and maybe you can help us clarify this, because I feel these concepts kind of get lumped together. U.S. reserve as a reserve currency, U.S. dollar as the payment system, and strength of the U.S. dollar, right? Should we be speaking about these separately? Because does the strength or weakness of the U.S. dollar impact either of those other two?
And vice versa, frankly. It is the liquidity in the U.S. dollar that is partly the author of its strength. If we look back at U.S. policy going way far back, well, first of all, before the SWIFT system, We didn't have the ability to freeze people out of interbank bank transfers because they weren't there. But I think that the US dollar has enjoyed a really, truly glorious franchise for a very long time. Before we began to be so overtly political with regards to our treatment of the dollar. The dollar, in effect, became everyone's reserve currency. And the power that that afforded the US, in particular the power of seigniorage, the ability to print the world's reserve currency, uh, because loans around the world and commodities around the world traded in dollars, there was more demand for dollars than if they could merely be used to purchase US goods and services. The franchise that we're busy destroying with regards to the US dollar is the single most important franchise in the history of the planet. We're doing our best to wreck it, but the truth is that the franchise is so deep and so valuable that despite our best efforts, when I say ours, I mean Democrats and Republicans.
Yeah.
Despite our best efforts, we don't seem to be able to wreck it.
Let me ask you this, Rick. I'm really curious to get this because I've had a lot of experts this year coming on that the Fed, so I'm throwing the Fed in here, the main mandate is to keep that U.S. dollar propped up to be the club that goes around knocking everyone off the head like a whack-a-mole game. So do you agree with that statement?
Partly I do. I need to say that you have a countervailing political idea around the world, which is to say that one of the ways that you manipulate your domestic economy relative to other domestic economies is to devalue your currency so that your export goods become more internationally competitive, which is to say you compete by lowering the living standards of your citizens. The United States appears to be less aggressively doing that than places like, say, Japan or China. But there are also countervailing political trends which would suggest that in many fiat currencies, what citizens have to look forward to is a continual race to the bottom. One of the reasons why I, Daniela, have always been attracted to gold is because gold doesn't have an internal political constituency in favor of devaluation. I'm delighted, frankly, that the Fed has decided to allow interest rates to rise because a policy of artificially low interest rates, on the face of it, penalizes savers on behalf of spenders.
Mm-hmm.
And a nation doesn't get rich by spending. It gets rich by savings. So the idea that the Fed, whatever their political motives has been, has allowed or even caused interest rates to go up, I think is on balance a very good thing. I wish the Fed would just get out of the way and let the market set interest rates, but of course that will never happen.
Don't we all? And that's a very solid point. Before we move on from just one other point about the strength of the BRICS, we see more countries being added here. Obviously, this year we saw countries looking for solutions outside of the U.S. dollar. They want to be, unchained from it. Is this a theme and trend that you're paying attention to? And what are your thoughts around the rise of the BRICS? And is that a concern?
I don't think it's a concern at all. To the extent that there is more trade between emerging markets, those emerging markets get richer, and to the extent that they get richer, we get richer. I'm pretty unconcerned about artificial political and economic groupings. All of these countries are acting in their best interests. I'm reminded of a phrase that says countries don't have friends. Their leaders and elites have interests. And to the extent that we recover our collective sanity, I can assure you, from having done business around the world for my entire adult life, almost everybody, I say almost everybody on the planet would rather do business with us than each other. The reason that you're seeing an increasingly anti-American coalition around the world, I would suggest, is because of the attempted artificial imposition of American values and American politics on their people. In other words, we're leaving them no choice. Whether or not our policies are superior to theirs is a different question, and that depends on whose point of view you're using. They, of course, are using their point of view, and they believe that they need a multilateral response to the artificial imposition of U.S. values internationally.
Very valid point. And how long until that, I'm trying to think of a pleasant way to say this, but turns around and bites the U.S. back?
I think it's already biting the U.S. But the truth is, and I hate to waste it, The truth is that the United States has such an amazingly deep franchise. I forget which economist said this, but there's a lot of ruin left in a country this great. Certainly enough ruin to last my lifetime and probably yours. I hope we don't test that thesis. But we have an amazingly deep economy. We have a culture that, were it to open itself up via passports, would still attract more immigrants and higher quality immigrants than any country on the world. We just have to be careful not to damage our franchise too thoroughly, too quickly.
I want to talk gold now. I'd like to get your assessment now. We have a few weeks left of the year. Who knows what's going to happen? But, there's really been two schools of thought, right? Those who feel gold, we're down around 2% on the year, has done great compared to the other assets, compared to the S&P, compared to Bitcoin. And others expected more, that gold should have performed better this year given everything happening around the globe. What's Rick's take?
Gold did everything I wanted it to. I own gold, not gold stocks, but gold itself as an insurance policy. And gold maintained its purchasing power. Gold maintained its purchasing power despite a more than doubling of the deposit rates on savings products, which is much better performance than I would have expected. As we've said before, Daniela, I own gold for insurance purposes and I own silver for speculative purposes. I'm disappointed, of course, that the speculative part of my portfolio and physical silver didn't do better. I note, however, that in most bull markets, gold needs to lead and then silver, in fact, follows. With regards to the gold price, I think if the Fed is forced to pivot, which is to say, if rather than continuing a period of higher interest rates, they are forced because of deterioration in the economy, slowing durable goods sales, imploding real estate prices, a real equity bear market, and particularly in the face of very broad disintermediation of long-term bond holdings, then I think you'll see gold really, truly go off to the races. The last thing that I mentioned, Daniela, I'd like your listeners to pay real attention to. Rising interest rates murder the capitalized value of long bonds. And the institutional investors around the world, but particularly the pension funds, the profit-sharing plans, the university endowments, have portfolios that are loaded with long bonds. We saw what happened very briefly in the British gilt market when the capitalized value of the long bond declines, and the portfolio values of these very large investors decline to the extent that in order to meet the actuarial assumptions, they have to increase contributions to the pension funds. And of course, they don't have the money to do that. The great, I think, sort of unidentified bomb in the economy is the undercapitalization of pension funds in the long term to meet their obligation, and their overwhelming reliance on long bonds at artificially low interest rates. The twin perils for them are the decline in the capitalized value of those bonds in the face of rising interest rates and the negative real interest rates that they're getting. Yes, they're getting 400 basis points, but they're getting it in an instrument or in a currency where their real purchasing power is declining by 300 basis points a year. If you reduce the purchasing power of a pension plan by 200 or 300 points a year by 20 or 30 years, what you've done is guaranteed poverty for the beneficiaries of that pension plan in their old age. And I think that we have a political conundrum that we have to face 5 years from now or 6 years from now with the chronic underfunding of these pension funds, with our inability to maintain the living standards that the beneficiaries have come to expect that they will enjoy.
So that bomb is ticking now, not exploding yet.
Correct. I think that's right. And I think the political class would rather put off dealing with it until they're out of office, because there's no easy way to deal with it.
I know you've stayed away from the subject of crypto and Bitcoin, but is there any thesis or conclusion that can be drawn by the difference in the performance of gold versus Bitcoin? Folks like pitting these two assets versus each other.
For a 69-year-old Luddite, gold is easier to understand than crypto. The value proposition around crypto, I think, has been its anonymity, which crypto adherents are trying to get rid of, uh, and the ability to have frictionless
Yeah.
trades. I love the technology around the blockchain, and I think that the blockchain and the distributed ledger is the future for securitization and securities transfers. With regards to the product, which is to say crypto, it attracted a whole bunch of people because its volatility. But its volatility reduced its utility, which is to say the fact that it went up and down rapidly may have attracted traders, particularly the up part. But the truth is, unless you lived your life entirely in Bitcoin, if you went to buy a cup of coffee with Bitcoin, you never knew what price you were actually paying for the coffee. The very volatility in Bitcoin that attracted speculators and promoters reduced its utility as a medium of exchange and as a store of value.
What was Rick Rule's take, or is Rick Rule's take on the FTX disaster?
That one's easy. The complete abdication by the institutional investment community of their fiduciary requirement to do due diligence. It is very common for me, if I'm going to make a large investment in a company, to ask, as an example, to see the non-private notes from directors' meetings. Very common. These guys didn't have any notes in their directors' meetings. I mean, there was no there. There was what was allegedly a $30 billion equivalent value asset pool that wasn't there. Where was the due diligence? One of the largest and finest venture capital firms in the world, Sequoia, a firm that used to do, I have personal experience, extraordinarily deep due diligence on technology, on finance, on corporate bylaws, had $300 million into a fake sack of assets. It is impossible that Sequoia, and I'm not picking out Sequoia,
Right.
they were just one of many,
Right.
but it's impossible that Sequoia did the requisite due diligence
Well,
that
that's
should
where I'm
have been
scratching
done.
my head. Then I'm happy you're bringing this up. Where was the due diligence?
Where was the due diligence by the SEC and FINRA with regards to Bernie Madoff? When your listeners believe that the big institutional investors, and in particular the big regulators, have their backs, that's the beginning of the end of their fortunes. You need to be your own regulator. You need to do your own due diligence. Listen, Bernie Madoff was supposed to have an audit every 2 years. I know, I was in the securities business. I had audits every 2 years. Now, Mr. Madoff had a circumstance, and you'll understand where I'm going in just a second. Mr. Madoff had a circumstance where in the audit they were supposed to pull 20 or 30 trade tickets. They were supposed to call the counterparties, and they were supposed to call a bank. In other words, they were supposed to audit these transactions drawn at random. Now, Mr. Madoff didn't have any transactions. So it's very clear that if he was subjected to an audit, that the audit didn't include basic audit protocols. When my auditor, when I was still in the securities business, came to me and asked me if I had any questions about the audit process, I said, yes, I do. Bernie Madoff, if you guys had conducted an audit on him, you would have caught him, and you're required to have an audit on him every 2 years. What went wrong? And my auditor said, Mr. Rule, the enforcement staff of the SEC in Los Angeles is curious about the same thing. The similarity is that the big thinkers, the protection that you believe that you enjoy as an investor in the United States, either by way of the reputation of the largest institutional investors in the country, or the protection that you expect to enjoy from the CFTC, from the SEC, from FINRA, it doesn't exist. You need to protect yourself. Enron is an example of a fraud that should have been easy to catch.
Yeah.
Madoff is an example of a fraud that should have been easy to catch. FTX is an example of a fraud that should have been easy to detect.
And do you
The
blame?
only line of defense that you have, Daniela, is you.
Well, and what about the line of defense that a lot of these celebrities, and I'm not going to name them now, who have come out and said, we were all fooled by this, but yet they were paid millions of dollars to endorse FTX. Is that enough of a defense that, hey, we didn't know what was going on?
Well, that's a different circumstance. And again, that's the fault of the investor. Why would you care? what a basketball player or an actress has to say about how you ought to invest.
Because
I
people
care
trust those
about,
people, folks. People trust those people, unfortunately. They see them as idols.
and as long as people are dumb and trusting, they will be separated from their money, including those athletes and actresses who were influencers. I think, Daniela, this has to do with the fact that, as we said earlier in the interview, we've come through 40 years of very benign climate. We've come through 40 years where the wind was in the sails of the economy and the wind was in the sails of markets, and people made too much money too easily. We came to believe, for some reason, that people who had excelled in basketball or in television drama knew something about finance. I think we're beginning to learn a lesson. We're beginning to learn that the SEC is, in many senses, a political body, that FINRA is an organization that serves the interest of the financial services community, that Congress holds court in an advanced auction of stolen property called politics, that actresses probably should act, that basketball players probably should play basketball, and that investors themselves should spend some time knowing something about what is being done with their money.
You can always count on Rick to be the voice of reason, all valid points. If you follow Rick Rule, you know that one of his biggest life lessons is have cash on hand, be ready, be prepared to scoop up deals. I am a student of yours, Rick Rule. How important is it right now to have cash?
I think it's critical.
6 months ago, critical, like at what spectrum, like what level?
I think it's critical. I think investors need to understand that holding cash imposes a cost, because the deposit interest rate that you receive is less than the decline in the purchasing power of your savings, which is to say your currency is depreciating at 7%, you're getting paid 4% interest rate. It costs you. But I think that cost is going to be necessary. I look at that cost, the foregone interest, if you will, as an option payment on the ability to have cash so that I can take advantage of volatility rather than being taken advantage of. I think that there's a chance, I don't know how good a chance, but I think that there's a chance that we're going to suffer a liquidity squeeze in the next 5 years, that we're going to have a replay of 2008, probably around institutional investors and the long bond. I think that the long bond is the mortgage security crisis of this decade. And having the cash will give you the tools and hopefully the courage to take advantage of the situation rather than being taken advantage of. It's important, too, when you deposit that cash, to think about the solvency of the depository. I think it's not unlikely that we have some bank failures. I think it's not unlikely that some of the non-bank financial players that pay very high interest rates will go broke. I think it's not unlikely that we will have a credit squeeze in the junk bond market. So those investors who are looking for higher rates, particularly in junk bond ETFs, need to be very careful about the form of investments that they make to hold cash or near cash assets.
And speaking about scooping up depressed sectors, Rick, let's talk mining a second. Do miners need a higher gold price, energy in the gold market to catch a bid here? Or can they do it on their own?
If you're talking about the market as a whole, the answer to that is yes. The market as a whole, that is to say the miners as a whole, consume rather than generate cash. But if you are looking at the best of the mining business, they're doing extraordinarily well at these prices. I am attracted to mining as an investment because I spent 45 years learning how. The idea that you would simply buy the gold mining sector, the idea that you would come into the penny dreadfuls willy-nilly because you thought the gold price was going to go up, of course, ignores the fact that most of them don't have any gold. They're looking for gold.
Yes.
So I think it's important, not just in the mining sector, but really across the economy, that you become selective. I really think we're coming into a stock pickers market. I think we're coming into a sort of a Buffett type market where, because of volatility, because you have frequent sales, which is to say market declines, People who become good at securities analysis, people who become good at picking stocks, begin to enjoy 30 and 40% internal rates of return, while the rest of the market participants
Uh-huh.
enjoy, if that's the right phrase,
Right.
a 4 or 5% annual decline.
But you have to do your homework. It takes a lot of
Yes,
homework, right?
yes, yes. No free lunch, Daniela.
I want to end on this note, and this is why I wanted you to come on. Whether folks are believers or not, regardless of your, religious affiliations, or whatnot, if not, I think it's a time for reflection. We can look back on the year, and I feel that you've always enlightened us all the times you've been on my show with such great wisdom. So, as we're about to start a whole new year, a new chapter, just some reflections from Rick Rule here.
Well, the first thing is be nice to each other. It's a consumer good. I think most people in the world enjoy making other people smile more than they make other people frown. So invest in those relationships and invest in yourself. The beauty of today's technology is that there are so many sources of information now. You don't have to listen to the Wall Street Journal. You can listen to Daniela Cambone, which, in
That's
my
right.
point of view, is much more pleasant, frankly. I think, too, that you can't be afraid of the circumstance that's in front of us because it will paralyze you into inactivity, and inactivity guarantees you a loss. But I think that you will need to be much more focused. You will need to do much more work. You will need to be much less trusting of society at large, and you will need to develop relationships where you can trust, because trust is essential. But you have to allocate your trust to people and institutions that deserve it. You have to be much more discriminating than you would have had to have been in the past. Believe me, Daniela, the future of humankind is in the ascent. In the ascent. So you need to be optimistic in the long term. You need to be cautious and applied in the short term. You need to buy things that are cheap. You need to buy things that are out of favor. And if something doesn't make any sense, like FTX, it's because it doesn't make any sense. You don't have to be afraid of missing out. You have to be willing to make money in circumstances where you outcompete
Yes.
your peers.
You don't have to be afraid of missing out. I love that. I knew you would deliver that home run. Thank you for enlightening us with that. You are
Daniela,
the gift that keeps on giving, Rick Rule.
if I might give a little more,
Please.
I would love to assist your viewers with their natural resource stocks. And to that, any of them who go to my website, ruleinvestmentmedia.com, and list their natural resource stocks will get a Christmas present from me. I will rank their natural resource stocks for free, no obligation, 1 being best, 10 being worst. Further, Daniela, as a gift to humankind and myself, I'm celebrating retirement by starting a new bank.
Yes.
Battle Bank. If any of your listeners believe that they could enjoy better banking relationships, as an example, receiving fair interest on their deposits and their checking accounts, or if they think that they ought to be able to borrow easily against good collateral like gold, check out Battle Bank. Or when you've submitted your portfolio to me for ranking, in the question and comment section, write bank.
And I just want to specify, write this on Rick Rule's site, because the last time they were writing it in the comment section of our YouTube channel. No, on Rick Rule's site.
Yes, ruleinvestmentmedia.com. That's right. Thank you, Danielle. It's been a pleasure.
It's been an absolute pleasure. Happy holidays to you and your beautiful family, and thank you.
And to you. I'm delighted to have this one final chance to visit with you in 2022, and I look forward to a rematch in 2023.
Same here. Thank you. Thank you, Rick Rule, and thank you all for watching. I wish all of you happy holidays on behalf of the Stansberry Research family, and we'll see you soon. Thank you for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.